to introduce today's keynote speaker, John Fernald of INSEAD and San Francisco Fed as today's keynote speaker. The measurement of productivity, as you well know, is a topic of major importance. Indeed, it constitutes a substantive research theme at ESCoE itself and has featured in a number of sessions at this particular conference. We're therefore fortunate that John, a leading scholar in this area, would deliver today's keynote address. So John is going to speak for around an hour or so, so that will leave time for questions and comments. So without further ado, John, thank you very much.
Thanks very much. All right, well, thank you very much. It really is a pleasure to be here. This is so I have some idea of what time I have. So I'm going to talk a little bit about the world, mostly towards the end. I will start by talking about the US, where I've worked a lot, and I will talk then go to Europe, then I'll spread it out to the world. So the end part will be joint with Mehrdad Esfahani and Bart Holbein. The earlier part is with a range of co-authors. I will say this has been a really enjoyable conference. I've learned a lot. The papers here have been fantastic. I am primarily a user of economic statistics and economic measurement of the sort that people here are doing, and so I really have appreciated the insights and challenge and attempts to address challenges that you've seen here at this session. Many of you were probably at Chris O'Donnell's talk. When I say productivity, he says he never knows what people mean when they say productivity. I will be thinking about either labor productivity or total factor productivity in a standard Tornquist-style way. Now, there are various ways one could introduce this. I'll start with a quotation from Chairman Alan Greenspan of the Federal Reserve in 2000, when he said, "When we look back at the 1990s from the perspective of, say, 2010, we may conceivably conclude that at the turn of the millennium, the American economy was experiencing a once-in-a-century acceleration of innovation." Well, he went on to say, alternatively, that retrospective might well conclude that a good deal of what we are currently experiencing was just one of the many euphoric speculative bubbles that have dotted human history. Now, in the past few decades, we have arguably seen several euphoric speculative bubbles. But in the US productivity data, we have seen the rise and fall of exceptional productivity growth. And so that will be the angle that I will be taking on this. Now, another motivation, again, thinking about hope versus reality, comes from a picture I've seen many people show. So this shows output per capita in the US for the business sector. So you see that up until the Great Recession, you're growing. We have not gotten back to anything like any kind of reasonable linear trend you would have put through the data as of the pre-Great Recession period. So in some sense, this picture applies to many other advanced economies as well, which is why I'm showing it. The US is just one example. I'm actually going to argue that this picture is misleading, that in my view, that is not what the trend would look like. I don't personally think there was a big permanent effect on US output from the Great Recession that this would seem to suggest. Obviously, there are many channels in which it could matter, in which a deep, whether through capital accumulation or influencing labor markets or affecting innovation, or perhaps causing an increase in misallocation. But in the US context, I'm not persuaded that that's the story. Now, before I get to productivity, which is the main thing I'm going to talk about, let me highlight one aspect in which this is misleading. It's per capita, but that includes people over 65, and as people get older, they tend to work at lower and lower rates. So one of the big things affecting potential growth rates in basically all advanced economies is demographics. So if you think about the working age population, so this is the US, and an annual percent change, it was growing at whatever this is, close to a percentage point a year here. It's going to be barely growing in the next few years. And so we're not going to get back to the same overall growth rates that we saw in the past, unless we see either you get more workers from this, the mapping to labor force is imperfect, or we get a big boost in productivity growth. The UK looks somewhat similar. Was growing, had much faster growth in the 2005-ish period than you'll see now. Japan, of course, has had a declining working age population since the mid-90s. So overall GDP growth in Japan is going to be held down just by that. Europe is also negative now, and it's gone negative since the Great Recession. So we're going to have fewer workers than we would have thought otherwise. And if you look at even China now has negative growth of the working age population. So for overall growth, we are thinking demographics are going to be a big factor, making it very hard to get back to the growth rates we thought were normal in the pre-recession period. And that has nothing to do with the Great Recession. It has to do with the fact that the leading edge of the baby boom generation hit 65 in 2012. And so people in their 60s work much less, and even less as they go forward. So now let's turn to productivity. So what I'm going to talk about in the remainder of my time. So I'll talk about why advanced economy growth has been slow since 2009, at least my view on that. Well, my view on that, shaped by a paper, by work I've done, including a paper with Bob Hall and Jim Stock and Mark Watson, is we viewed it as a sharply slowing trend in growth. And that came from the labor force, because a lot of that, the aging population, and modest growth of productivity. Neither of those factors do we think, in the US context, were heavily affected by the Great Recession. And so why was productivity growth so modest? So my own view is we saw a pause or a stop in the IT revolution sometime before the Great Recession. And the timing is important. It was before the Great Recession. If I look at other advanced economies, you can look at the productivity numbers and think sometimes it was the Great Recession. But it's important to keep in mind, European productivity growth has been slowing since the 1960s. But that's been happening because countries were converging. But since the mid-90s, they've been diverging. So in some sense, it's the mid-90s that is a big breakpoint when you look in the cross-country evidence. And many people in this room 15 years ago were writing papers about that. I think of Mary and Marcel and others who were talking about the shortfall of European productivity growth even before the Great Recession. Now, I won't talk much, if at all, about measurement, but work I've done with Dave Byrne argued that the slowdown was not mismeasurement, or that we're missing more growth. Obviously, there are many issues we are missing, and many of the sessions here we're dealing with that. The challenge with the mismeasurement hypothesis is that it's not new, that we're always trying to keep up with things that we're not measuring properly. And then I'll turn to the world as a whole. Productivity growth, despite the advanced economy slowdown, held up until about 2011 because of China and India. One of the things you really see in our cross-country work is a misallocation of labor term in a growth accounting sense. We can talk about the interpretation later, in which labor was growing faster in low-wage locations, and that was a drag on world productivity. So depending on time, I'll talk more about that. So if we go back to this picture for the US data. All right, so how are we going to see whether there's what the cyclical effect is? So the way I'm going to did this in a paper with Hall, Stock, and Watson, is we took any variable, say the growth rate of output, so call that variable delta y, and we did various things in our paper to try to control for the cyclical effects. But one of them was to use an Okun filter, an Okun's law, where we regress the variable, say output growth, on leads and lags of changes in the unemployment rate, and took this as the cyclical effect. It's the amount, how much would you expect the variable to change given the movements you saw in the unemployment rate. And the residual from that is going to tell you conceptually how much would output have changed if the unemployment rate had been constant, rather than doing what it did, which of course unemployment rates shot up in all advanced economies and then have come down. So if we do that and we apply that Okun filter and then accumulate the residuals, so we did that in growth rates, so this is a level figure where we accumulate the residuals. I normalized the level so that it was the same right prior to the recession. What you see is this sort of Okun trend flattens out a little bit before the recession, and then it flattens out further immediately after the Great Recession. So that, of course, is just accounting. It's just sort of mechanically applying Okun's law. But we can apply the same thing to all of the growth accounting pieces that would explain output growth and say, well, in approximate sense, what accounts for this? And what we found is two things account for it purely in an accounting sense. There are other things that could have been. These are the ones that actually mattered. One is TFP growth that relative to previous recoveries grew only modestly. We'll come back to that. And then labor force participation plunged. And this is cyclically adjusted. So it was enough to make hours worked per capita, cyclically adjusted, which peaked in the 1990s. So that's been steadily coming down. And a lot of that is aging or trends that look to predate the Great Recession. I won't talk about the labor force part, but both of these we thought were forces independent of the recession itself and the slow recovery. So for productivity, we can talk more about that. So if I turn to productivity, well, if I think about what explains output on the output side, you can do standard growth accounting. You say log of output, or log change of output. Well, it should be given by TFP growth, plus the contribution of capital, plus the contribution of labor, say quality-adjusted labor. Now, one of the challenges in this, if you want to say account for growth, is capital's endogenous. So you don't want to just say, oh, capital grew more slowly than it did in some previously, and say, oh, capital shortfall of investment explains the shortfall of growth. The Solow model is a textbook example of that, right? When the textbook example in the Solow model, technology or TFP shock would explain everything of output per capita, but the growth accounting, when you apply Solow growth accounting, will attribute some of it to TFP and some of it to the induced capital deepening. Now, a standard rearrangement of this equation gets the accounting right in standard models, which looks at output, says the growth rate of output per hour depends on TFP in labor augmenting form, so dividing by 1 by alpha, plus the contribution of the change in the capital output ratio, plus labor quality. So so this gets the endogenous effects of capital, that if capital is growing slowly because something's going on in the labor market, or capital is growing slowly because TFP growth is slow, well, that will be, then it will show up, it will load on TFP. It won't load on capital. So if we do that, let's start with TFP. So we start with TFP. This is the accumulated growth rate of of standard TFP residual in black. Red is a cyclically adjusted one, in this case adjusted with the Oken filter. And you see growing modestly up to the mid-90s. Then you see this sharp increase in growth, which a million papers have written about. And then you see prior to the Great Recession, you see it growing more modestly again. In fact, the black line was actually falling going into the Great Recession. So the actual TFP growth was actually a little bit negative well before the Great Recession happened. So you can try to do break tests on this. They of various sorts. One of the nice things about writing a paper with econometricians is they can come up with all sorts of break tests that say there's very little probability mass on the likelihood that this slowed at the Great Recession or after. The slowdown statistically looks to have happened earlier. Now, I'll come back to that in a couple different ways coming up. Before I get that, let me show you what the capital output ratio looks like. So the black is the actual capital output ratio. I think it's scaled by alpha over 1 minus alpha. Right, so it is strongly countercyclical, right? In a recession, capital output ratio shoots up. Capital is relatively smooth as measured. Output falls. And then in the recovery, it comes down. Well, we saw that same pattern in the Great Recession and after, right? Capital output ratio was really high, and then it has come down. Now, the red line is what happens. You run it through the Oken filter to get what would you expect given the changes in the unemployment rate. That's much smoother. The blue line is just a by-weight filter trend run through it. Now, I think the levels don't mean anything, the relative levels, because it's a normalization, because they're accumulated growth rates. But in either case, you see, say, in the red one, we're right on a pre-recession trend. There's no sign here that we were missing some capital that we would have expected. And again, given what's happened on the labor side, which I won't talk about, and what's happened with TFP, the capital output ratio doesn't look unusual. It looks like what you'd expect. Now, for the dynamics of labor productivity, that's going to be important, right? You have this long period. Well, businesses came out of the Great Recession with a lot of capital. What they didn't have was the demand and the workers to need that. So capital deepening added very little over this period. That's going to be important for the dynamics of labor productivity as opposed to the dynamics of TFP, where things look much smoother since the Great Recession. Now, in a bar chart form on TFP, in some sense, because labor productivity growth looks, for most of the period since the 1970s, has been pretty modest. So in the 40s, the 47 to 73 period, as we all know, labor productivity and growth in the US was very fast. It was very slow. We had the productivity slowdown and slow growth in the 70s, 80s, early 90s. A decade of fast growth, then on average, much slower growth. Now, in a sense, I discover I've become a statistical agency by default because I produce growth accounting that I post on my website that decomposes this in a conventional growth accounting way into TFP in blue, capital deepening. Here I've done it the conventional way, capital per quality adjusted hour, and then the contribution of labor quality in orange. It's really the TFP that explains the fast growth, the slow growth, the fast growth, and then consistently in these different subperiods I broke it into, slow growth. Now, you do see here the effects of during the Great Recession. Why was labor productivity in the US strong in 2007 to 10? Well, the capital deepening effect, I mean, we already saw that, right? The workers who were left had a lot of capital, and a labor quality effect. Now, in some sense, the workers who lost their jobs in the Great Recession were lower skilled, either on observable things, maybe also unobservable things, but unobservable things that you can measure in a labor quality index. So the people who were left working were the cream of the crop. And so the labor quality in orange added a lot during that period. Well, since 2010, we've seen the same TFP growth rate as we saw before the recession and during the recession. We've seen very much less contribution of capital deepening, the same as we saw in that capital output picture before, and less of a contribution of labor quality. So in some sense, we've seen slow growth of labor productivity relative to TFP in the period since 2010. But that's just offset, that's sort of undoing the cyclical dynamics of what we saw during and immediately after the Great Recession. Now, if I look at the most recent quarter of data, in that dot, labor productivity in the business sector, by my estimate, rose 2% year over year. The headline BLS number was a little faster than that, but I averaged the income and the expenditure sides of the accounts, and in 2018, the income side grew more slowly. Now, so that looks good, right? It's better to have a good number than a bad number, but even since 2004, the standard deviation of year-over-year changes in labor productivity is 1.4%, and this is 7 or 8 tenths faster than its post-2004 mean. So it's about half a standard deviation above its post-2004 mean. So it is far too early to say that there's been a change in the productivity regime from a slow regime to a fast regime. Now, if I looked at industry data as another cut of the US data, to this, I've broken US TFP growth, these are going to be Domar-weighted averages, into 4 pieces. So one is IT production in orange, right? In the one is IT production in orange or yellow. One is market services. I've done this different ways, but this is one that a number of people find useful to think about wholesale retail trade, distribution more generally, information technology, the like. Then I did bubble sectors to get at things that where unusual things were happening prior to the recession, construction, real estate, and so forth, and then everything else. So if you're looking, you see the boom period, it was really IT production and market services. So stories, all the stories at the time were emphasizing things like the use of information technology in wholesale and retail trade that transformed wholesale and retail trade. Because there were companies that were exceptionally good at using IT to reorganize their logistics chains. And after about 2004, that went away. Now, some of that is just the inefficient mom and pop firms were disappearing from the data. So there was a reallocation towards the high productivity firms. I'll come back to that in Europe, where that was hard, you didn't always see that. And certainly that's the argument that many people, including this room, have made. Now, after 2004, you've seen a much smaller contribution directly from IT production or in market services. Of course, the IT production almost goes away at the end. I would ask Dave Byrne if he believes it's really gone away that much. He's done a lot of work on the deflators. It probably, I think that's an area where, if I understand the research, we probably are missing some of the quality changes going on. But in terms of does that mismeasurement contribute a lot to overall to what's going on in TFP growth? Well, on one hand, we import a lot of those goods. And so that's not going to affect US TFP growth. But the other thing is if you're deflating the TFP, if you have a better IT deflator that's falling faster, then the true growth of capital is faster. And that's going to make everyone else, in terms of TFP, look worse. And so, in fact, the overall TFP effect would actually be to lower the effect if you did better deflators in IT. Obviously, there are many other areas you can think about mismeasurement, but I, again, don't think that's the main story. So my view when I look at the US data is the timing suggests that it wasn't the recession that caused the weak TFP growth, right? If TFP growth slowed earlier, it had to have been something else. Now, there are lots of intuitive reasons why a big recession might cause a decline in innovation or capital accumulation that would show up in TFP. And those stories may apply elsewhere. I just don't think they're the main story in the US. I would note, even before the recession, people were noting the productivity growth was weak. It's not just an ex-post Rationalization. Olin, Sickle, Styro, Jorgensen, Host, and Styro had papers. I had an economic letter that noted the productivity growth had been weak for the 3 years before that. Of course, I was an optimist, and I discounted it, and I said, well, it's too early to say that the benefits of information technology have gone away. But other professional forecasters had also been lowering their forecasts of long-run growth, even before the recession. So the timing, to me, looks clear. We also have non-recession stories for this. I mean, mismeasurement would be one, but I don't think that explains the data, because everyone, just about everyone who's looked into it says it's not large enough, or the timing doesn't work because we were always missing mismeasurement. In the U.S. context, of regulation contributing maybe to a lack of dynamism is a popular story. Now, when you look across countries, differences in regulation look like they can explain some of what was going on. So it's intuitive that it could matter. But in the U.S. context, first of all, a lot of the people in the U.S. who are talking about it want to focus on 2008 changes in regulation. That doesn't work, right? The timing doesn't work, because you have to explain a pre-recession slowdown. Plus, there was more regulation in energy and in finance. And in, say, finance-intensive industries actually look better than non-finance-intensive industries. They have less of a slowdown. So that story doesn't look like it works. In the Fernald, Hallstock, and Watson, we couldn't find a link in some things we were looking at between industry TFP growth in the US and industry-specific regulation. So I don't think that can explain the story that well. My preferred story is it was a return to normal after an exceptional IT-linked decade. Right? In the early 2000s, everyone was talking about how it was information technology. Nick, Sally, and Shashanta Basu and I were writing about IT as a general-purpose technology. But those stories all have essentially a sequence of, or a flavor of a sequence of one-offs. Right? There's a business figures out a way to do something better and implements it. Then another business finds out something and implements it. So the logic of it says it's not necessarily a permanent change in growth rates. It could be just a persistent change in growth rates that happens over a while. If you look at industry data, it looks like IT-intensive industries and market services were big ones that were benefiting in the late 90s, early 2000s, and then in the US context, after 2005, that went away. But it's important that this is my preferred story, partly for want of another one, partly because it fits the facts. Now, if I turn to Europe, let me do everything for now. Let me start with pictures that are relative to the US. So I'm going to do TFP levels, where the US is 100, and these are data from Gilles Berset and his co-authors at the Banque de France. So if I look at the UK, well, the UK in the mid-90s was basically at US levels of TFP. By the Great Recession, they were basically at US levels of TFP. Now it has fallen off. So the UK is one country where something right around the Great Recession does fit the timing. Now, if I look at France and Germany, they were at, or say in the Germany case, above US levels of TFP by these estimates in the mid-1990s. Even before the Great Recession, they had drifted down. They'd fallen short. And they've continued to do that a little bit. So this was, of course, widely noted. That's why many people were writing about this. Italy and Spain were striking because they have just collapsed in terms of TFP. Italy has lost 25% relative to the US since the mid-90s. The raw TFP numbers have been negative in Italy and Spain since then. In some work I did with Gilles Berset and Benoît Maujean, we really almost just summarized existing stories with a little bit of new evidence in a couple areas. But our story for the US was the one I just told. There was an exceptional, the issue was the exceptional decade. Right? TFP growth was modest, shot up and was very fast, and then it's been modest. It looks like a return to normal in that sense. It was the 90s and early 2000s that were unusual. France and Germany, I would point to work that Gilles Berset had done, but also the work at people like Groningen and elsewhere, looking at structural rigidities in labor and product markets that made it harder to reallocate in response to benefit from information technology, harder to hire and fire and promote people in ways that were maximizing productivity. And low productivity firms sometimes stayed in the data longer. They didn't exit as much. And high productivity firms didn't expand as fast as other people have found. Italy and Spain, for want of a better story, I will point to the literature that looks at rising misallocation. And that finds that even within industries, misallocation was getting worse. So that low productivity firms stayed in too much and never exit. And high productivity firms don't expand. And so a number of papers from Italy and Spain have highlighted that. And that's been sort of a popular story. Some of it may have been related to the euro. So there are variants of the story in which the introduction of the euro led to a lot of capital inflows into peripheral Europe. And with financial frictions, those inflows were not necessarily allocated to where they were most productive. So Ricardo Reis has a story like that. Gopinath et al. Have a story like that that have gotten a lot of attention. But if I look at the kind of picture that people at Groningen were producing over the years of looking the same kind of bar chart I did. So for 9 countries, decomposed into the same groupings of ICT production, market services, the bubble sectors here, finance and construction, and everyone else. So it's ordered from lowest productivity growth to fastest. But what really differentiates the countries is market services. So that's, in one sense, the original EU climate story, Bart van Ark and Marcel and Mario Mani and Robert Inklar, as an example, where Spain and Italy had massively negative TFP growth in market services. The countries on the right all had big positive contributions from market services. So other things were more mixed or idiosyncratic across groups. Now, if you go to the 2005 to 2015 period, nothing really jumps out. It's anemic everywhere. So there's not sort of a clear industry distinguisher. Italy and France look better than they did in the 95 to 2005 period, only because they are less negative than they were. So their pace of decline has gotten smaller. So broadly, I would come down to thinking, a lot of the issues in Europe, whatever for different countries can be different. You have common shocks of information technology, rise of China, and the Great Recession, and countries respond differently. But my easiest summary of this is the problems are many of the problems are the same as they were before the Great Recession. And where countries didn't get the benefits of information technology then, and they still haven't. So the lesson I take from advanced economies is there's been a widespread across countries and industries pre-Great Recession slowdown in TFP growth. The stories may be heterogeneous, may differ for some countries at the frontier. I think the information technology was adding less, that we plucked the low-hanging fruit. Maybe we don't know what the future holds. We might get another harvest. We might build taller ladders and get fruit higher up on the tree. Some new trees that are being planted may eventually bloom. So we don't know what the future holds, but at least that's my take at the frontier. There are other countries that are much more heterogeneous in terms of their response to the shocks we've seen, but a big dividing point was the mid-90s, when countries in Europe stopped converging and started diverging. Now, there are a lot of issues I haven't discussed. Of course, intangibles. I probably won't discuss it even in what comes. I think that's important. I don't think that explains the slow productivity puzzle that much in a direct sense, but it is important and becoming more important. Now, there's a growing body of work that suggests there are rising markups, and reduced competition might play some role in reduced innovation potentially, but it also affects our measurements of TFP growth. One of the things I would note, going back to Vasko's talk the other day, is the aggregate effects also depend, with imperfect competition, depends on who purchases goods, because the marginal product of a factor depends on not just on its factor price, but on a markup. And so it will depend on who's buying it, and I'll come back to that. A lot of literature looking at misallocation. I talked about that a little in the context of especially Italy and Spain, but other countries as well. I'll come back to that. But we've also seen just this rise of the global economy, with especially China and India being more integrated in the world economy. So in the remainder of my time, I want to turn to the rest of the world as well. So again, this is joint work with Bart Hobein and a student of his at Arizona State, Mehrdad Esfahani. So the data we're going to use for this is from the World Input-Output database. So does that and the associated data allow us to do global growth accounting? Now, there are a couple of vintages of this, but broadly, the summary, we're thinking about 40 countries and 36 industries. So at a country industry level, that's 40 times 36, which I think is 1,440. So Marcel, of course, is going to be the expert on this. Any questions you have about the data, I'm going to refer to Marcel. Now, the data cover about 80% of global GDP. But if you compare sort of fluctuations over time and what output looks like in this data set, it looks like output from the World Bank or the IMF of world output. So you're capturing the vast majority of the economic activity in the world. Now, there are two vintages with a similar set of countries, but a more limited set of variables in the 2016 vintage. And capital data really have only till about 2007. So I'll talk a lot about labor productivity in what I talk about, with some results for TFP towards the end. And I'll focus on qualitative results that are common across the vintages. And so I'll blur the difference between the vintages apart. Now, that issue I mentioned of that there's been a lot of literature looking at, say, falling labor share. And one interpretation is it's rising profits. There are other interpretations that I'll try to come back to later on. Now, one of the ways you can try to you can construct profit rates by using one way to try to do it is to use an external nominal return in the user cost equation and figure out what required payments to capital would have been. Now, this would use a Hall-Jorgensen style equation. Bob Hall did that in papers in around 1990. Shashanto and I did that in some of our early papers, where we sort of did an external rate of return and got to allow for pure profits. More recently, Barkai does this and argues that there's been a big increase in profit rates. I mentioned Karbar, Brunis, and Nyman, who do this, but then also raise some alternative interpretations, one of which is in intangible capital, which Marcel and Bart have worked on. Another is maybe we're getting the interest rate wrong. So I'll talk more about that interpretation. But for now, when I show you some results, I will use a triple B rate as the nominal rate. You can get a profit rate out of that, because then you have a required payments to capital and a residual, which would be pure profits. You can use those profits, if you assume constant returns to scale, to get a markup. And so in some results I show you, I will have a markup which I will get that way. Now, I will, as I mentioned, we'll use labor productivity, so output per hour, and use for some, at least up until 2007 with the older vintage, we'll do some TFP things. We do sort of standard, fairly standard looking growth accounting things of output minus share weighted inputs. Now, the approach we're going to take, and, in the paper we write down, a problem. We write down a distorted planner's problem that allows you to get a bunch of somewhat normative interpretations of the decomposition I did. But I think of the decomposition we do as being accounting identities that are part of a long history in the literature of thinking about how do you aggregate industry shocks into aggregate output. Conceptually, you could do firm shocks, but much of this was thinking about starting from industry data. Chuck Holton being a key contributor, showing that essentially DOMAR-weighted TFP at an industry level will give you aggregate TFP. Jorgensen, Golub, and Fraumini extend that, allowing for differences in factor prices across, say, wage rates or rental rates for the same factor across uses. And you get some reallocation terms added to the Holton aggregation equation. Now, these are identities under the, if you use standard measures of TFP. Within perfect competition, those standard measures of TFP are not technology. In some papers with Shashanto, we tried to think, well, how do we aggregate in that case? And so we had some aggregation equations. And there's some more recent work as well, some of which I'll mention. Of course, there's also a very large literature that thinks about how to aggregate across establishments and the role of reallocation of resources across establishments. Those are not usually quite the same, going to add up to aggregates that you observe in the national accounts because the data are not quite right. But with industry data, you often have data that add up and that are internally consistent. So that's the approach we're going to take. Now, the setup will have, at least conceptually, you can think about each country industry as having a production function. So, there are 40 countries, 36 industries. So there are these I's. I runs from 1 to 1,440. And output is going to be produced with capital, labor, purchased intermediate inputs from anywhere else in the world, which we have the data on in the World Input-Output Table, and some residual Z, which we'll here label as technology. Now, the setup in general will allow for factor-specific taxes, output taxes, and a markup of price over marginal cost. We'll call that markup of 1 plus mu. So 1 plus mu is price relative to marginal cost. Now, the standard cost minimizing first order conditions, if we apply them here, would say that, well, the value of the marginal product, the price times the marginal product, is going to be equal to the wage times the price marginal cost markup, 1 plus mu. So this is conventional. If you have a markup, well, if you have perfect competition, then the value of the marginal product is going to be equal to the wage. Within perfect competition, then the value of the marginal product exceeds the wage. Now, that's going to be important when you think about allocating resources different places, right? Because if you have different markups, you'll have a different social value of the marginal product in different uses. If you have a different wage across producers, you'll have a different social value of the marginal product in different uses. And output, in our standard aggregation, when you have chain aggregation, will value different outputs using prices. So these are reasons why, if the W's differ or the mu's differ, then you'll have a different value of the marginal products. Now, one thing I will come back to very, very briefly at the end is all of my accounting, the nominal values, are in dollars, because you need something to convert across countries. So everything is going to be current US dollars when I look at nominals. Now, that matters when you think about, well, wages might be different across countries because of price levels are low in some country, right? So you may want to think about doing a purchasing power parity adjustment, both to the price level, to the local price, to convert it into, say, US, into comparable units across countries. And then if you did that, because this equation would hold, if you adjust the price, you would also adjust the wage. So I'll come back to that. But I will say that actually, when we tried to do that, we're going to get a big reallocation effect or from moving from labor. And that'll, adjusting for prices, essentially for cost differences across countries, will only account for about 1/3 of the difference that we're going to find. Now, we have this set up. One thing we can do is we can differentiate the production function in this sort of very standard Solow-style way and impose the cost-minimizing first-order conditions. So I'm calling this a Hall equation because it's the variant of the Solow equation Hall used. So in this equation, dots are mean variables in growth rates or log changes. So the growth rate of output is the markup, 1 plus mu, times share-weighted growth rate of inputs. Now, the shares are going to be shares in revenue. If they're pure profits, the shares won't sum to 1. And then I've normalized the elasticity of output with respect to z to 1. So I'll just carry around a z dot. OK. So now I can take this equation and then go to basically some identities from growth in accounting. So the first one is, well, what's aggregate output? Well, obviously, within a country, you'd think about doing it from different ways. You could do the expenditure, the product, the income side. And in real terms, you could think about just the value-added side. And aggregate, the value-added growth is going to be share-weighted growth of industry value-added. And we can do the same thing across countries. For most of this, we'll allow those. By the way, I've suppressed time subscripts, so everything would have a time subscript. For most of this, we'll do things as a Tornquist with time-varying shares. In some places, the time-varying shares will matter because we've had a shift of shares towards emerging markets. But for many things, it won't matter. Now, at a country industry level, value-added growth, and the standard Divisia formula for it would be value-added growth so it's a gross output relative to industry value-added times output growth minus the contribution of share-weighted intermediate inputs that the industry purchases. Now, one intuition, which I will come back to, is this looks like a partial Solow residual. You're subtracting off the term in brackets. You're subtracting output growth minus the share-weighted intermediate input growth. But we saw from those first-order conditions, if there's imperfect competition, you're not getting the full productive contribution of those intermediate inputs. There'll be something left over. So there are different ways you could end up writing that, but we're going to have a term later on that is basically keeping track of that something left over that will show up in aggregate output. So now let's go to, I'll start with TFP, then I'll talk labor productivity. So starting with aggregate TFP, well, TFP at the world level, it's going to be output growth minus share-weighted input growth. So V dot, so value-added growth at an aggregate level minus capital share times capital growth minus labor share times labor growth, where we've aggregated the capital and the labor across everyone in the economy. Now, after plugging in from the Hall equation, doing a little bit of rearrangement, you get this ugly expression, in which we can say that world TFP growth depends on what's going on at a country industry level with 4 terms. So I'll talk about those each in turn. So let's start with the case, what if there were no markups? So mu was 0, so perfect competition. Well, in that case, this first term is just the standard Domar-weighted country industry TFP term. So you have the ZIs at the country industry level, and then you weight them with the ratio of industry gross output to aggregate value added. That's what that Domar weight SDI is. So this is a standard growth accounting thing going back to Domar and Hulton and so forth. And then you have a couple of other misallocation terms, or sort of reallocation terms, sometimes called in the literature, of capital or labor. That I'll explain the intuition for those a little bit later, but basically they're going to come down to whether you have the different factor prices in different industries. So it's not going to be as it's conceptually straightforward what those terms are. Now the markups create some additional terms. So we've modified the Domar weights a little bit. So we modified it by taking the same SID times ZI dot and pre-multiplying here by 1 over 1 plus mu I. Well, what is that doing? Well, 1 over 1 plus mu I is the ratio of marginal cost to price. So what this is doing is essentially a Domar weight, but where we're using marginal costs rather than prices in the weight. And then there's that extra piece over here that is basically that capturing the shifts in markup, so the markup effect that we didn't, and how it affects value-added growth. So it's a piece that we didn't, that captures the fact that we didn't fully subtract off, in a productive sense, the contribution of intermediates. Of course, it's not just intermediates. There's also the fact you're going to have over here. We didn't have a markup on the left-hand side. This was just an accounting expression, and there was some extra contribution of capital and labor as well over what their share-weighted pieces would have been. That's also going to be captured in there. And then we have this misallocation of capital and labor term. Now, I would note before I move on, this decomposition is not unique, right? It literally is an accounting identity you can take to the data, but you can rearrange things in other different ways, and for different purposes, it may be useful to rearrange it, right? Because you can take this y dot term over here, and you'll go back to the differentiated production function and substitute into the y dot in different ways and rearrange things. So Basu and Fernald, when we were working on this 25 years ago, we wrestled with this. Well, where do we put different terms? Because conceptually, it matters. Who purchases a product matters, right? If I produce something, I sell it to Kevin, well, the marginal product of that actually depends on Kevin's markup. And so if he has a different markup than Marcel does, and I sell it to Marcel instead, the value of of what I've sold is different. So you have to make some assumptions about the allocation of resources. So we made a particular assumption in what we did, and we got a different rearrangement of this expression. The reason we use this expression is that it isolates different frictions, right? I mean, the first piece, it looks like you have the markup there, but really all it does is it's taking the markup out of the price. And then you have the effect of the markup as a friction, and you're going to have any effects of frictions in capital markets and labor markets. And so these have been, isolate the frictions. So that's why we've done it this way. Bakai and Fari, in a recent paper, argue very strongly that you have to use a different aggregation equation. But it turns out to be a different aggregation equation that is, in general, extremely hard to implement. It requires a ton of data. They say you have to do it this way, and then they say, well, we don't actually have the data to do it. So they don't implement it. So then in a recent paper came out, I think, a month or two ago, they said, well, here's our preferred thing, but you can also use this other equation that turns out, when we look at it, to be exactly the one we've been using. So apparently even Bakai and Fari will be fine with our decomposition of this. But my view on this is, there's not once you find these other terms mattering, you can argue about where they should be and how to interpret them. But I would not say, I'm not ideological about an accounting identity. Now, with labor productivity, we're going to have somewhat slightly different things. So labor productivity in the aggregate will just be output growth minus labor growth. Now, my L dot here is actually going to be hours growth. I should say that. You can do some things with labor quality in the data. We actually haven't. So that's, but when we've experimented with that, it's not the main thing that's explaining anything we find. So you just think of it as being aggregate hours growth. Well, you can write that as depending on country industry growth in labor productivity, weighted by value added, because we've already got everything in value added terms, plus some reallocation terms. Now, I'll come back to those in a moment. Now, it's going to be useful to say, well, we had from that TFP accounting, we had a shifts in markups term. So we can add and subtract that term. So for some purposes, it'll be useful to say how much of this country industry labor productivity is explained by shifts in markups, the term we've talked about already on the far right, and how much is net of that. But that's just an arithmetic rearrangement. And then we'll have essentially reallocation of labor term. There's a reallocation between countries and industries with different labor productivity levels. So conceptually, you can think, why would a level of productivity be different? One reason might be factor, in the thinking about what's going on in the accounting, it could be factor shares are different. We don't want to say that's a problem, but it could be because wages are different. And that would be the part that we've already had, that is going to be the misallocation of labor term. Of course, it could be that returns to capital are different. So here's the piece for which you kind of have some normative things you can say about it. And then there's sort of everything else about the reallocation of labor across producers with different marginal products, where I won't say anything about that term. It's just going to be a reallocation term that I can't say anything about. OK, so now we can get to what the data look like with all of that preamble. So this is average labor productivity growth. Here it's just from the 2016 vintage. In red is what world average labor productivity growth looks like. Output growth, value-added growth at an world level minus hours growth. It is hugely volatile, right? It was really strong in the run-up to the Great Recession. Falls a lot, falls again in 2011, but it bounces around a lot. So the country industry piece, now it's just value-added weighted growth of country industry labor productivity in the 1,440 industries is the blue line. It's much smoother. So the things that are going on within sectors and within countries are only part of what's going on. There are the big reallocations of resources globally that at an aggregate level are going to matter. So people have looked at this within countries and also found some gaps that are sometimes large, but not always. But in the world context, this turns out to look really big. So we'll want to, in the next few minutes, talk about what some of those things are. Now, on that blue, if I go to this blue country industry line, one of the things you really see, it being much, so it's much smoother, right? At the end, it goes growing lower, but it holds up much better, right? It doesn't, and more consistently. But you see this real shift in the composition at a country industry level towards emerging markets. So in the aggregate, the country industry total, so the blue line, over various selected subperiods, where I think it's up to 2007 is the old vintage, the 2013 vintage, and then this is the 2016 vintage. So you see, up until the end, relatively smooth growth of country industry labor productivity. But you see what we talked about already. We see the slowdown in advanced economies. This is a contribution to growth, which is adding much less in 2005 to 7, and even less in the subsequent period. And then you see this shift towards emerging markets, at least in the 2005 to 2010 period, where China and India start adding a lot. Now, to show you, I don't have the shift share analysis, but it's sort of two things going on. One is these countries are becoming a larger share of the global economy, so they're getting more weight, and this is a contribution, so it's share weighted. And so they're getting a larger weight, and they're growing fast, so that boosts the numbers. The other thing is their productivity level growth rates held up better than in advanced economies. So both of those factors matter. Now, what's interesting at the end of the data is you're getting a less of a contribution, both in advanced economies and others, but it'd be good to see what's happened in the past 5 years, and I don't yet have that. Now, I had that markup term. Given the markups we've estimated, which if I look at them, I mean, they didn't, when I tried to just eyeball them, they didn't look crazy, but we have a lot more to do on that. Maybe it's 5% markups on average. If we have the country industry total, that blue line I showed you before is this top line. Well, the shifts in markups, are actually, accounting for, 0.5 to 1.25% per year of that country industry labor productivity growth, given what we've gotten. So those markups, quantitatively, are important. Now, this is labeling, a residual, essentially what you would, in a particular way. It's labeling, that not, what Karabarbunas and Nyman called factorless income as markups. an open question is, is it potentially something about missing intangibles? Is it a return, differing returns to capital? We've labeled it a particular way, but that term looks large with the way we've labeled it. Net of the shifts of markups, you do see this sharp slowdown, especially even at the end, where it turns negative. Now, let me talk about this labor misallocation term for a minute, where I had these long expressions, and then I had this term of a labor misallocation term, as I called it. So that term looks like this. It's value-added shares. We're adding up over the industries, value-added weighted times labor share in value-added at an industry level, times the difference between labor growth in the industry and aggregate labor growth. Well, let's unpack that and rearrange it a little bit. So in particular, let's assume there's, that labor and capital are both fixed, and let's hold the distribution of capital itself fixed. And just think about changes in the distribution of labor. That I might hire fewer workers, and Dave might hire one more worker. And what would the effect of that be? Well, if I take that, then the change in output is going to be, okay, this expression, I can unpack it into the value-added weight times labor share times the, L dot is the change of output over the level of output, minus the revenue-weighted labor growth. Well, I can cross out a bunch of stuff, that it can cancel out, and numerator, denominator, the LIs, and simplify to get this expression, 1 over nominal value of world value added times the sum of wage-rated changes in hours. So if I had just two producers, and I shift a worker from one firm to another, what happens to output? So if the L1 is negative of the L2, well, substituting in here, we can write the change in real value added depends on the difference in the wages between the two producers times how many workers we moved. So this term will only show up if there's a difference in wages. It could be from difference in taxes. It could be from something else that makes labor immobile. But that fundamentally is what's going to affect this. Now you can always see, since I'm doing everything in dollar terms, in nominal terms, that the dollar versus, say, a PPP weight is going to be important. And so so we do try things where we can think about doing a PPP adjustment, where this is adjusted for the purchasing power of the worker in one country. But otherwise, if I shift someone to where they have a higher wage, this is going to be positive. If labor is growing fast in a place where the wage is relatively low, this is going to be negative. So in the data, you see big shifts from this labor misallocation term, mostly negative, not always, but mostly negative, where labor was growing very fast in low-wage countries. And so you see a big negative here. So China and India growing fast, a big negative. It's not per se globalization. It's just they were growing fast, and they have low wages in dollar terms. And so that turns out to be a big contributor to the volatility in world dollar-level GDP per hour. Now, I think the final thing I want to do is talk about TFP through 2007, where I have the capital data. So we had this expression that I derived before with this sort of complicated-looking expression. But again, we can identify all that. The country industry TFP levels, the extra effect of markups, and the reallocations of capital and labor. So I'm going to do actually this two ways, because this is, I think, sort of suggestive to me or interesting to me. One is the way I've been doing it with markups, and then I'll do it without markups. So with markups, we see world TFP growth, 1.8%, very slow in 2001 to 2004, much faster 2005 and 7. Unfortunately, then the data run away, or data stopped. Country industry TFP growth was actually fairly constant. Just as we saw before with labor productivity, what's going on at a country industry level is much smoother than the aggregates. Now, if I'd done this without markups, I'm going to get actually a different TFP growth rates because I'm weighting capital differently. Because now capital's weight is going to be 1 minus labor's weight. Whereas on the left, it's not, right? Conceptually, some of it was profits, which I'm not allowing to affect the capital weight. So we'll get a little bit different growth rate of aggregate TFP. Country industry TFP actually isn't that much affected, right? That turns out to be pretty robust to that. Even though I'm weighting capital differently, but then I'm weighting the industries differently as well. And so the effects matter by a tenth or two. Now, with markups, now we have the same shifts in markups term we had before, which is quantitatively pretty large. We have very little misallocation of capital, right? Which is, again, coming from different factor prices of the same capital across producers. But that's really not very interesting, right? Because I actually assume the same nominal rate of return. So, in fact, given that there may be some differences in the data in the P dot term or something else, but this is basically, it should be 0 or close to 0, and it is. The misallocation of labor is what I found before, which is large. Now, if I'd done this without markups, now there's no contribution of shifts in markups. So where did the extra, and the TFP growth, the country industry total was similar. So where did the TFP growth go? Here it went to the misallocation of capital term. Now it looks like capital is shifting, and these are all positive. Capital is shifting to places where it has a higher user cost when you just take user cost, the payments to capital as a residual. So that I thought was kind of interesting. That the country industry was consistent. This is the place where things get moved around. Now, I don't show it here, but if I broke this up into is this going on within countries or across countries? Well, the misallocation of labor piece is actually primarily coming from labor growing faster in low-wage countries, rather than a within-country effect. With capital, it's mostly going on within countries. It's not that capital is shifting to countries or growing faster in countries with high marginal products. It's within countries they're growing. Capital is growing faster in places that either have a high profit rate or a high, say, risk premium, or it's coming from some mismeasurement of intangibles that we are here associating with a misallocation of observed capital. Now, the final thing I will only mention is I did this all in dollars. You can try to think about deviations from purchasing power parity, saying we want a different relative marginal products of resources. We did that using some deflators from Robert and Marcel. Well, we can explain about a third of the labor misallocation term. So PPP alone, or the cost differences, the fact that labor is cheap in China and India, is not enough to, and because prices are cheap in China and India, those cost differences are not enough to get rid of this labor misallocation term. So to conclude, well, what have I talked about in the past hour? Well, on advanced economy levels, I think the big issue with productivity is what was going on before the recession. It's not just stuff happening during the recession itself. When I think of continental Europe, I think a lot of those concerns are similar to the ones that people in this room were writing about 15, 20 years ago. So then, now if we think, is growth going to pick up? Like, what's a reasonable growth rate to expect in the future? Well, productivity is inherently hard to forecast, right? Changes in productivity, no one has a good track record of. What we know is it's been slow. And my best guess is if it's been slow for a while, these regimes last a while and it will stay slow, but I don't have a high confidence in that. But population is still aging and going to be growing more slowly. If I look in many countries, certainly including the US, educational attainment looks to be largely plateaued. We're not going to get the same boost we saw in the 20th century in educational attainment going forward. So that extra boost from labor quality. And we're not going to get the same cyclical boost that we got coming out of the Great Recession. So the headwinds to seeing a big recovery of growth seem quite fierce. Now, despite this advanced economy slowdown, at least from 2005 to 11 or 2005 to 10, we saw productivity growth at a global level, at a country industry level, stay strong, especially because of China and India. So if we think about measurement issues, Having better data for China and India, where no one has a high degree of trust in what's going on in the data, that would be a high priority. It would be helpful for all of our attempts to understand the big trends we're seeing in the global economy. And one of the interesting facts that come out of the global growth accounting is that a lot of the volatility, as well as some trends, are coming from labor growing faster in countries with low wages. And that's only partially explained by low costs. Okay, thank you very much.
Thank you very much, John, for a fascinating address.
Thank you.
We've got quite a bit of time for questions, comments from the floor. When you do so, would you give your name and affiliation, and please use the microphone. So, please.
Culture through to manufacturing, through to services, through to this something called a knowledge economy, whatever that might be. The world's changing. So I think, actually, I like to pick up towards the end of what you said. Is there a massive paradigm shift that we haven't really embraced? So many of your charts went back to the early 90s, but if you go back, say, 50 years on those charts, there's some very short-term movements in the recent periods that almost lead us astray to some conclusions. So there is a productivity slowdown earlier, but it's not been as pronounced. So where I'm coming from is, in the 90s, there was massive investment in IT in the US, and we couldn't work out why were the productivity gains not coming through. So the producers, the enablers were running away, but actually the users, the lag was there, and the productivity came through later. So there is a lag with innovation and investment, and I'm not sure if that lag has now changed today compared to 20 years ago and 50 years ago. Now, when I come to the digital and the internet, we've got a lot of gains in productivity. Now we start talking about things like blockchains. And where I'm coming from is, when we had gas, electricity, steam, etc., we had massive changes to the way we did our production activity, the production function. Huge changes to productivity. Is the new paradigm that the new innovation and investment is such that the rate of returns on productivity and the rate of increases are now going to be much smaller? There's less marginal return compared to when electricity came about. All of a sudden, you could say the world changed in a way. Now, the items like blockchains, are they now really marginal? So therefore, the trend growth that was there, if you go back on a 50-year chart, as opposed to the last 10-year chart, is actually changed. And it's something we need to look into. And then I'd finalise with two other aspects. The globalisation issue, has there been a breakdown in the labour and capital relationship? So companies now are obviously moving labour abroad, but they may not own the capital. Now, I'm not talking about the IP, I'm talking about like the fixed assets. So you've got a different relationship of production with different activities of labour and who pays for the labour, versus the capital and who pays for the capital in order to produce the output. So there's a labour and capital shift that may be happening as a result of globalisation. And then as a person from a statistical office, I have to look at the quality of the data, etc. In terms of Wired, my only caution is, like many of these databases, many countries are on different bases and are moving towards 2008 SNA. Some people are still moving from 68 SNA, 93 SNA. And obviously things like capitalisation of R&D makes a big impact. And all my point there is caution in the interpretation when you do the cross-country analysis.
Okay, quite a lot to...
Yeah, I mean, your first point was getting in the speculative metaphysics of how do we compare social media to electricity. And And so certainly that's one of the arguments is, well, social media just is not as important as electricity and before that steam. I mean, it's very hard to know because that's why I'm labeling it speculative metaphysics. And that, Bob Gordon has strong views about what the future holds. Eric Brynjolfsson has strong views, and they differ. I'm a little bit more agnostic on that. I think on the small level, when I've gone back and tried to look, well, what, were people thinking that the mid-90s there was going to be about to be this big U.S. productivity breakout? Well, of course, we all were aware of the Solow paradox at the time. I was looking if there were people really pointing the internet's going to really change everything. No, but within a few years they thought it. Every business found a way to do it. My own sense of that was, I remember sometime around '95 having to write a memo with the Board of Governors about why I had a business reason why I needed access to the internet. Now, realistically, when I was thinking, why do I want access to the internet? I wanted it so I could get sports scores more quickly. And it's true, having access to the internet allowed me to get sports scores more quickly, but it also allowed many other things that for businesses that have been much more productive. I mean, I think on the breakdown in labor capital relationship, again, it's that's in the speculative range there are big trends going on in the global economy that we are struggling to figure out. Some of them I touched on, some of them I didn't. That I would put down as one of them. That is, are there big changes? Monopsony power in some places, monopoly power rising in others. The shifts of the global value chain can even, as a measurement issue, very hard to say. Where is the output? Because where is the value added? Certainly Bart and Marcel have worked on, and better quality and better consistency would be great.
So can you put up hands so I can get I'll go for the guy at the back actually next after this one, but Peter.
Peter Sinclair, University of Birmingham. Very, very interesting talk. Thanks so much. I'd just like to ask two related questions. One, price marginal cost wedges are fantastic, but there are other wedges too, particularly the first law of credit markets. You can get a loan when you can prove you don't need it, which really hurts new and small firms and means that there are interesting problems which could affect measures of labour productivity and TFP growth. The other is the period, the 7-8 years from 2004, bear a strong resemblance to the 7-8 years after 1974. And the big difference seems to, a big similarity, is not just the collapse of output and productivity growth, TFP and labour, but also the big swing in energy and metals prices and the, at least ex post, collapse of real interest rates. So I just wonder whether there's a full way of incorporating that possibility in studying your period. Thanks very much.
Credit wedges are something in my accounting. They're going to show up as saying really there should be differences in user costs for small versus large firms, say. And then, of course, I mostly assume that away by assuming the same nominal return. But of course, that could also show up in the Z-dot in terms of factors that affect innovation. And that's something that at the industry level, you really have to dig on much deeper into the firm data and establishment data to get there. There's the resemblance to the 70s. I mean, one thing that was striking to me is, of course, there was in the post-73 period, and when people started realizing there's been a productivity slowdown. I mean, the big culprit people pointed to was energy. There was this massive energy shock, and we see this big slowdown in productivity. And over time, fewer and fewer people think that was the cause of the productivity slowdown. And so most people, maybe not everyone, has given that up. Maybe you haven't. So I don't see that as the cause of the productivity slowdown at the time. I see it as we had maybe the Bob Gordon story. I mean, we had a tremendous half a century, a tremendous run, and inventions not invented earlier that were improved for a long time, and eventually those the benefits of those general purpose technologies ran out. I mean, that's my story. I thought that also my PhD thesis was looking at the interstate highway system and thinking that added a lot in my identification to growth in the 50s and 60s, but it had run out, right? It stopped being exceptional. So there is that resemblance, but where I see the resemblance is I see that we now think it was the Great Recession, and it was not all because we had the Great Recession around the same time, and I see it as being two big things that happened around the same time that were not necessarily the same,
Okay,
or not necessarily linked.
A question at the back there. Next, please. I think this will have to be the last question, I'm afraid. I'm sure.
Richard Hayes, ONS. For my sins, I produce our productivity statistics. You touched on mismeasurement very quickly and suggested that this wasn't a big issue. I'm very supportive of your confidence in that, but I'm wondering if you could take us through what drives that confidence or what measurement risks you think you might still see.
So, I mean, what drove my confidence was writing a paper with Dave Byrne. That was partly inspired by work done by Goldman Sachs that said, oh, look, growing mismeasurement is incredibly important. And their evidence for this all pointed to papers that Dave had written. And so Dave and I wrote a paper together, and we said, well, let's not just look at what it means for the recent period, but take it back further. So a lot of it was things that were focused especially, not entirely, on IT-related hardware, software, and getting consistent deflators for that. But also incorporating some of the work on intangibles and trying to say, well, if we added that, what would that work? Can that explain the dynamics when we account for both the unmeasured output and the unmeasured service flow of the accumulated intangibles? And what we found is problems we were missing a lot in the 90s and 2000s. So like we're missing, Dave's estimates said, well, we're missing more of the benefits or more of the gains in computers and cell phones now than we were in the 90s and early 2000s. Problem is, from a US perspective, in the 90s and early 2000s, the US produced these things. And by the end of the period, the post-2004 period, the US was producing fewer and fewer of them. So essentially, the Domar weight of these things was actually getting much smaller. So larger mismeasurement, but a smaller weight, and it was the smaller weight that dominated. That would be an example. And then running through some other adjustments that, on balance, didn't help explain the results. And then you have other people have worked on that as well. But one of the big unmeasured things and challenges is all the free goods that you get on the internet, or the way we're changing how we live. I think we're changing how we live much more than how we produce. So some of that comes to looking at time use. Some of it comes to non-market production of whether it's entertainment or communication with our families or data, information we produce on Facebook. And it's much easier now to stay in touch with my 500 closest friends than it was 20 years ago. So benefiting, getting those benefits are a challenge.
Thank you. I'm afraid we're out of time just now, but I'm sure John will be willing to take questions at the close of the session. Shall we just thank John again for a most interesting talk. I'm going to pass over now to Rebecca Riley, who's Director of ESCoE, for closing remarks. And thanks again, John. Thank you.
Thanks, Richard. So the ESCoE was set up just over 2 years ago now. And the key objective was really to create a collaboration between the ONS and the academics to work together to improve economic measurement through R&D, to improve UK economic statistics. And this conference is a key part of that exercise. And I would like to note that this collaboration is a new way of working for many staff at the ONS and for many of the academics involved in the ESCoE. And so it's been really wonderful to observe the goodwill towards this endeavor that's evident at this conference, both from statistics producers, statistics users, and also the academic community, the research community, both in the UK and also from outside the UK. I'm also delighted to have seen over the past couple of days people at so many different stages of their careers engage with the economic measurement agenda, including many PhD students. I think that we're at a moment in time where there are real opportunities to make a difference to our understanding of the economy and our society with new data and through innovation in economic measurement. That was, in any case, the main message that I would take away from the conference over the last couple of days. So we had this fantastic panel session yesterday with lots of ideas for taking forward and changing the SNA or developing the SNA to improve our understanding of the modern economy. And the day before, we had a very interesting panel session on trust in economic statistics, many insights there, which, very relevant in this age of omni-measurement, as it's often described. We've had inspirational keynotes, a very, very broad set of topics covered by all of the papers here over the last few days. And I think that that demonstrates that there are real opportunities for making improvements in economic measurement and describing the world we live in. And it's not all about the modern economy, of course. I hope you had a chance to check out the online repository of historical UK economic data that Ryland Thomas and Sally Srinivasan have put together, or are still in the process of putting together. It's a joint project between the ONS and the Bank of England and the ESCoE, and lots of crates of dusty books have been passing through our offices at the National Institute, and will continue to do so as they basically take all that material and stick it online so that we can access it much more easily. Before we all disappear, I would like to just note a few thank yous. First of all, a very big thank you to Martin Wheel, sitting right here, Professor of Economics here at King's College London, and Richard J. Smith, who you've just heard from, sitting here at the front, a Professor of Econometric Theory and Economic Statistics at Cambridge. And both Martin and Richard have a very long-standing record of contributing to the development of economic statistics and working with the ONS, working with the Government Statistical Service, and we're very fortunate that they're so involved in the ESCoE. So thanks for putting together such a fantastic program for the conference. And also a big thank you to Mary Omani at the back. She's Professor of Applied Economics here at King's College London, and she's the reason we're at this venue. She's made the facilities available here at Bush House. Formerly the headquarters of the BBC World Service, Bush House has basically undergone a transformation here, recently been refurbished, and now houses the King's Business School and other parts of King's College London as well. And I'm sure you'll agree it's quite an amazing venue. And also thanks to the events team here at King's, and especially Tom Smith. Tom told me yesterday that this conference has been the biggest event that they've held here at Bush House, at least since the current residents moved in. So thanks for making everything run so smoothly, and also for the wonderful catering. Also a special thanks to Mercy Keener over here and Sarah Shepherd. They're part of the ESCoE team, and they've worked pretty tirelessly recently to make sure that everything here worked as well as it did. And also to Fiona Daw and Caroline Lewis and their team at the Office for National Statistics for their organizational support. But most of all, thanks to you all for your contributions to the discussions over the last couple of days and for engaging with this conference. I hope you've had a fruitful time, and that you've met some new people, caught up with colleagues, and that you'll leave the conference with some new ideas. So I hope we'll see you again in a year's time for Economic Measurement 2020. Have a lovely weekend.